Well, if you're an investor mentality, what you should do is you should dollar cost average. That's the best in a bull market. And that way it takes a lot of emotion out of it. Look, when you're buying silver or gold or both, what are you really doing? I mean, I'm an Austrian economist, and by definition, capital is the means of production. Capital is producing wealth. I mean, I would love to, invent a car that gets 200 miles to the gallon and employ my money into something like that would not only help me financially, but would help, all the, everybody on the planet more or less that drives. But I don't have the ability to do that, at least not right now. So when you're actually saving in silver and gold, you're basically taking what we think of as capital out of the market for some future purchase at some point. And it's a savings, so it's good from that aspect, but it isn't really helping the economy grow when you take it out and just hold on to it. In other words, it's more or less a stagnant investment. So coming back on point, I like dollar cost averaging, and if you're in a bull market, you just put in the same amount of dollars or euros or francs or whatever into the market every month at the same time, more or less, and you build your silver and gold money that way. And that one, like I said, gets rid of the emotion, it teaches discipline, and over the long term, you'll get a good average price. But what most people do is they read somebody on the internet or listen to a speech or whatever, and they get very excited about a market, not necessarily the silver market, any market, like the technology sector back in the 90s. And they, oh, I'm missing the boat, I gotta get in right now, and they put everything they've got into one sector and maybe one or two stocks or one or two without doing enough due diligence, enough research, and then the market moves against them and they're very disappointed and frustrated. So you really don't want to do that. You want to act like a professional does. When a professional gets into a market, they go into what's called accumulation, and then they do what's called distribution. They have too big of positions to get into any market in one fell swoop. They'll move the market too fast. So if they want to get a position, they will accumulate it over time, and when they want to sell a position, they'll sell it over time, and they're never looking for the exact bottom or the exact top. They're looking to take a good portion out of the middle of the market, which is exactly the best way to do it. So I would say dollar cost average is the best way to approach it.